Nigeria is one of the biggest crypto markets in the world, bigger than most countries you'd expect. But here's what nobody tells you. Most Nigerians investing in crypto right now are doing it completely wrong. Not because crypto is a scam, because the way it's being sold to you online is. By the end of this video, you'll know exactly how crypto investment actually works, the 3 mistakes draining the average Nigerian investor's money, and a framework for doing this safely without falling for the next guaranteed 300% in 30 days group chat. Let's start with why this even happened here, of all places. Nigeria has one of the highest crypto adoption rates on the planet. Not because everyone suddenly became a tech bro, but because of 3 very real, very local problems. The Naira keeps losing value. Traditional banking has limits and restrictions that frustrate everyday transactions. And there's a generation of young people locked out of formal investment options who saw crypto as the only door that was open to them. So when CBN restricted bank access to crypto exchanges back in 2021, it didn't kill the market. It just pushed everyone to peer-to-peer trading instead. People found a way. That tells you something important. This isn't a passing trend. It's a structural response to structural problems. But here's the catch. When something becomes this big this fast, scammers move in just as fast as genuine opportunity does. And that's where most of the damage happens. First mistake. Investing money you can't afford to lose. Crypto is volatile. A coin can drop 40% in a week. If that money was rent, school fees, or business capital, you're not investing, you're gambling with your survival. The rule professional investors use: only put in money you could lose entirely and still sleep at night. Second mistake. Chasing alpha, calls from strangers online. Every day, thousands of Nigerians join Telegram groups promising the next big coin before it moons. Almost all of these groups exist for one reason: to pump a worthless coin, get people to buy in, then dump it once the price rises. You're not getting insider information. You're the exit liquidity. Third mistake. No exit plan. Most people have a buying plan and 0 selling plan. They buy on hype, then freeze when the price drops, holding out of hope rather than strategy. A real investor decides their exit point before they ever buy in, not after panic sets in. These 3 mistakes alone account for the vast majority of money lost in crypto here. Not the technology itself, the behavior around it. So if crypto isn't inherently the problem, how should it actually be approached? Firstly, treat it as a small slice, not the whole pie. Financial advisors generally suggest keeping high volatility assets like crypto to a small percentage of your total investments, something you can afford to lose without it derailing your life, while your core savings stay in more stable instruments like money market funds or treasury bills. Second, use dollar cost averaging instead of timing the market. Rather than dumping a lump sum in hoping for the right moment, DCA means investing a fixed, smaller amount regularly, weekly or monthly, regardless of price. This removes emotion from the equation and protects you from buying everything at the worst possible peak. Third, only use regulated, reputable exchanges. Verify any platform is licensed where possible, has a real track record, and isn't run by an anonymous Telegram admin promising impossible returns. If you can't find who's actually behind a platform, that's your answer. Fourth, separate speculation from your actual financial plan. Your emergency fund, your retirement savings, your business capital, none of that belongs in speculative assets. Crypto can be part of a portfolio. It should never be the portfolio. Let's be balanced here, because this isn't an anti-crypto video. Crypto offers something traditional. Nigerian investment options often don't. A hedge against Naira devaluation, near-instant transfers, and access to a global market regardless of where you live. That's genuinely valuable. But traditional options, money market funds, treasury bills, mutual funds, offer something crypto doesn't: regulation, predictability, and significantly lower volatility. You're not going to check a money market fund and see it down 30% overnight. The smartest approach isn't choosing one over the other. It's understanding what each is actually for. Stability lives in regulated investment products. Growth potential, with real risk attached, lives in the smaller, speculative slice that crypto can occupy. Here's a simple way to think about your money going forward. Start with your foundation, savings and stable investments covering your emergency fund and near-term goals. That's non-negotiable. That comes first. Once that foundation exists, a small percentage, something you genuinely won't miss, can go toward higher risk, higher reward assets like crypto, approached with DCA on a regulated platform with a predetermined exit plan. This isn't the exciting answer. It's the answer that actually protects people long-term. The Nigerians who build real wealth aren't the ones who went all in on a coin in 2021. They're the ones who treated speculation as one tool in a much bigger toolbox. If you want help building that foundation, the stable side of this equation, I'll leave a link below to a platform I trust for that exact purpose. Everything else, the speculative side, is up to you to approach with eyes open. If this helped you see crypto differently, subscribe to this channel. I'm breaking down African investment behavior like this every week. No hype, just what actually works.